Hello and welcome to another Facebook Live. And we're here discussing common IRS issues. If you are you worried about the IRS? Then you definitely need to tune in and listen to Jordan's tips and ways to avoid common issues. This is Jordan Moran. I'll let you introduce yourself.
Back for another week here, Jordan Moran, EA, office manager here at Stadler and Company, IRS resolution expert.
And I'm Samantha Brown. I'm the marketing coordinator here at Stadler and Company. And this week we have a few questions that were sent in. Last week we talked about what are liens and levies. And you can go back to last week's video to check that out. We have some people joining us. Thank you, Darlinda, for joining us again this week. It looks like Brandon shared our video. Thank you very much. Holly, thanks for joining us again. We're glad to have you.
Always a regular.
So this week we're going to step back and answer some questions and talk about what gets people into tax trouble. Common reasons. And one of the number one reasons things that we get questions about is retirement. So someone asked, I'm taking money out of my retirement early. What do I need to know?
Well, you definitely need to know, guys, that in most cases, retirement income is taxed as you take it out as a distribution. If you're under age 59 and a half, you could be subject to a 10% early withdrawal penalty. A lot of people don't know that or don't understand it or get very confused. When the company withholds the money there, they withhold 20%, and most times it's not enough, because if you take a large amount out there, you're looking at adding that to your other income, okay? And that penalty is added back at the bottom of the tax return, so you can get into some trouble there if you don't pay attention to what's going on. And no, definitely call your tax preparer. Hopefully that's an enrolled agent before you take that money out. It's too late if you call us after, and we get so many people to do that. It's a common mistake, and the money's gone because you're taking out for some reason there. So there are some exceptions to the penalty, though. I'll just give you three there. The first $10,000 of the money that you take out of retirement there, if it's your first home, you can waive the penalty on that. So it doesn't mean that the entire amount is not taxable. If you take money out for medical reasons, and you have to be able to itemize deductions, so you got to be able to use those on Schedule A. And then if you're unemployed for a certain number of weeks consecutively there, you could get out of the penalty as well. Another thing I want to mention, I know Samantha's got a couple other questions here. You do have state tax on that as well, and most all retirement companies will not withhold that for you. So you have to be diligent enough to put that back on your own.
So you said that if someone's thinking about withdrawing, that they definitely should talk to an EA.
Yes.
But just as a guideline, how do I know how much to withhold?
Sure. In most cases, as I said, if the company knows that you're under age 59 and a half, they're going to automatically withhold that 20%. That's going to be automatic. And as I said, most will not withhold the state tax for you. If you're taking out a small enough amount there, that you don't want all the money going to taxes there, you may be able to get away with 10%. But keep in mind, it's specific to your tax situation. Everyone is different. So 20% may be enough for someone, may not be enough for another. So
probably better to be safe than, like you said, after you take it out, it's too late.
After you take it out, that's it. It's gone. So
it looks like Julia joined us. Thanks for joining us. And guys, if you like our video, make sure you actually hit the like button there. That tells Facebook that you like our video, and it lets us know, kind of an ego boost a little bit, that you like our videos. So the next situation that we get a lot of questions about is, I'm self-employed this year. How do I go about paying taxes?
Sure. First thing you want to say there, or I want to talk about, is the difference between being self-employed and being a W-2 employee. When you're self-employed, you're paying your own portion of Social Security and Medicare. You're paying that on your own. No one's withholding that for you. So you get to the end of the year and you've earned all this money and you haven't paid anything in, you could be in trouble. Now that doesn't mean you're going to be in trouble if you don't have a profit on your business. Samantha and I were talking about that. you don't have a profit on your business, like you got some of these,
Direct
professions out
sales.
here, direct sales, Cincy, 31, a lot of those may not be profitable, so the money that you're making there, may result in a loss. You don't have to send any money into the government there ahead of time, or you don't have to put any money back. Like I said, the difference is when you're self-employed, you are paying that money in yourself. When you're an employee, it's being withheld for you and paid on behalf of you. So it should be taken care of if your employer is doing it right there. The self-employment tax, when you're earning money and you do have a bottom line profit, let's assume that in this situation, you need to put back 15.3%, and you do have an option to send that money in quarterly. If you don't send it in quarterly and you still owe a certain amount at the end of the tax year, you can have what we call an estimated tax penalty. And a lot of people don't want to pay that. It's usually very small, but it's something there that, like I said, a lot of taxpayers don't want to deal with that. SE tax, or self-employment income, the profit is added into your other income. So if you or your spouse has other income outside of that self-employment income, that's all added together, okay? So, self-employment tax is covered at 15.3%, but you may have another 15% in income tax there. So the minimum that you want to put back, as long as the other person on the return is properly withholding, is that 15.3%. And you also have the state. Okay, if we're talking about the state of Indiana, you're looking at 5% on that profit. Depending on state, state tax is different. That varies. Not the same everywhere.
That sounds pretty complicated. I can definitely see how people would get into trouble.
Right. And you definitely want to call. An enrolled agent or your tax preparer there and make sure you know what's going on. And as I said, be proactive on this, just like the retirement, and start early. Ask questions early. If you get to the end of the year in December and you haven't sent any money in, you could be in a tax situation there.
Okay, we have some people that joined us. Looks like Brittany joined us, and we have someone that needs a shout out.
It looks like we need a shout out to Miss Tinsley there. She may be watching there. Tinsley, you're going to learn a lot on this here or there. Should be fun.
And it looks like Bailey wants a shout out. Hi, Bailey.
Bailey wants a shout out. Everybody's wanting shout outs here. We might as well give Cody a shout out too here.
Yes, and
Cody
has a question. If I have a kid on December 31st, can I claim him for the whole year?
That is a very good question, Cody. Yes, you can. The child can be born at 11:59 on December 31st, and they're considered to live with you all year. So you do have earned income credit for that child if you qualify, child tax credit, as well as the dependency exemption.
So a lot of people are trying to have that New Year's baby, but it sounds like it's a pretty good idea to try for December 31st.
Yeah.
Okay, so Hunter, I recently hit a deer going at 105. Can I write it off?
That is not tax related. It doesn't sound like there, Hunter. You got me laughing with that question. There are certain things called casualty losses there, so you maybe could look into that as a casualty loss, but you have to meet certain limitations, and generally if you have insurance on your car, it's going to be covered. So if you have anything outside of that insurance reimbursement, maybe. Interesting question.
It looks like Ian joined. Thanks for joining us. And Julie had something to add from our discussion earlier.
Julie did have a comment specifically to a 401k, that $10,000 exception to the penalty on the down payment on a first home does not apply. So thanks for chipping in there.
Julia is one of our EAs and also one of our tax resolution specialists here at the office.
That's a good job.
So we have probably about 5 more minutes left. So you want to get your questions in.
Comments.
And if you're not comfortable commenting here on the forum, feel free to email Jordan your questions.
Right.
You want to give him your email address?
Excuse me there. Email is Jordan, Jordan, @stadlertax.com. Website is www.stadlertax.com.
And then he will respond either directly to your email or on our live chat next week, depending on the technicality of the question. But we definitely will keep private information private if you ask him a specific question.
Sure.
I an interesting state tax fact. I thought it would be fun to share because tax law is so complex sometimes,
Changes every
especially
year.
the state at the state level. In New York, there's actually no tax on the sale of bagels, but an 8.875% tax is charged if you get it sliced.
What?
So it might be better to slice your own bagels
That's kind of
if you're
crazy.
visiting New York.
I know Brittany joined there. She's a bagel person, so it's a good thing she doesn't live in New York.
Yes, you'd be slicing your own bagels. But I guess 8.875% on a bagel is probably not that much. But
No, but it's still a tax, and no one likes paying it.
so we talked about self-employment and retirement. Is there some other way that people usually frequently get into trouble with taxes?
Right. You can get into trouble even if you're a W-2 employee, okay? If you're claiming too many allowances throughout the year, you're a single person with, no dependents there, and you're claiming, single and five, and you have minimal deductions on the tax return, you can still end up owing the government, a large sum of money depending on how much you earn total throughout the year there. So just because you're a W-2 employee doesn't mean that you can stay out of tax trouble there. Don't want to be negative there, but you want to be very diligent in filling out your W-4 form there when you start a new job, or even when you update it from year to year.
And they could bring it in to their tax professional if they have any questions.
And that's another thing you want to be proactive on. You want to let the your preparer know, or even HR there at your company if they have any advice for you. Generally, they won't. You'll have to talk to a tax preparer. Get some advice on that so you don't end up in a tax situation. So, in closing here, I know Samantha's got a couple other things to say, but if you know anyone or have, IRS letters or have questions about retirement there, like I said, we'll do a free consultation. Generally, that costs around $250 there, so, we're willing to waive that fee to help a new client out there or a returning client. So just keep us in mind there for that. And
mention that you saw us on Facebook Live.
Yep, mention that you saw the video and you heard me or Samantha say something about it there, and we'll certainly extend that offer to you.
It looks like Darlinda has a comment. They get into trouble by working and drawing Social Security, so that's kind of a complicated situation sometimes.
Right. And we talked I think Darlinda had a question about that last week, and we kind of went into that a little bit there. So yes, if you have Social Security and you're still working, you could potentially pay tax on that Social Security income.
That's a good point.
Very good. So next week, what are we talking about?
Next week, we're going to talk about the do's and don'ts when dealing with identity theft, IRS scams. They're getting more and more sophisticated, and they are mirroring what you might get from the IRS. So sometimes it's hard, unless you bring it into a tax professional, to really even know the difference.
Yep.
So we're going to go into that more, because that also can get you into tax issues. And I know the identity theft issue can definitely hurt people when they're trying to file for their return.
Yeah, you may not think that's IRS related, but if someone filed a non-legitimate return on your behalf, acting as you, and they got a refund, your return isn't going anywhere until you get that resolved. And you could be looking at up to a year to two before you get that figured out. So you definitely need to see an enrolled agent in that case. All right. Good questions, good comments.
So we have one more minute before we're going to wrap this up in case anybody has any last minute questions. If not, be sure to tune in next week, same time, same place, Wednesday at noon. And like we said, we'll be going into scams and then also answering any questions that we get sent in. Do you want to give them your email address again?
Yep. One last time, email is Jordan, Jordan, @stadlertax.com. If you don't email or don't feel comfortable emailing there, you can call. Phone number 812-478-2800. I'm generally here 9 a.m. to 4 p.m. Monday through Thursday.
Absolutely.
So thanks for joining and commenting, like and share, and we'll see you next week.
All right. Thank you.
Thanks.